Meet Muntassir. He's a complete beginner who decided to try crypto trading. He started his first account with 10,000 rupees and a simple challenge: make 10 trades and see if he could turn a profit. On paper, he did incredibly well. Out of those 10 attempts, he got 8 of them right, giving him an 80% success rate. This chart shows the mystery of his challenge. You see his 80% win rate on the left, but right next to it, the overall account balance line steadily declines. At the end of his winning streak, he had less money than he started with. Muntassir learned a tough lesson. Winning the vast majority of your trades does not automatically guarantee you will make money. To understand what went wrong, we need to look at how Muntassir used the trading platform. He actually understood the controls quite well. He knew that if he expected a price to go up, he should hit the buy button. If he thought the price would drop, he needed to hit sell. He also set his quantity, picking the exact amount of Bitcoin he wanted to buy or sell with each trade. And he used safety nets. This price line shows what happens when the market moves his way. It hits a green ceiling, which is the target he set to automatically cash out his profits. Below it is a red floor, the stop loss, which automatically sells to prevent a big drop. He pressed the right buttons and guessed the right direction. But hitting the target doesn't always mean keeping the money. The mechanism quietly draining his account was something beginners rarely plan for: brokerage fees. The platform takes a small fee for every single transaction you make. Think of trading like driving on a highway. The broker sets up a toll booth right at the entry ramp and another at the exit. Because he was nervous, Muntassir kept his trips short. He would enter a trade, see a tiny $3 profit, and immediately cash out. This line graph shows that very short trade. He made a tiny profit, but watch as 2 large fee deductions appear. The combined cost of the entry and exit fees completely consumes what he earned. Constantly jumping in and out of the market without letting profits grow is known as scalping too tightly. It rapidly empties a trading account. In trading, traveling a very short distance is often more expensive than staying home entirely. Muntassir did have one major success: his Ethereum trade. In that case, he correctly identified an upward market trend and stuck with it. This strategy is called holding for the trend. You enter the market and let the trade run its course for a much longer period. Following our metaphor, he still had to pay the entry and exit fees. Because he traveled a long distance, the accumulated profit easily outweighed the cost of the toll. This requires patience. It takes nerve to sit still and not exit early when the market fluctuates along the way. The length and the total profit of the trade must be substantial enough to justify the initial cost of entering the market. Let's go back to Muntassir's final data to see exactly where his 10,000 rupees went. This ledger breaks down his real numbers. On the left, his gross profit was 1,680 rupees. On the right, total brokerage fees were 1,950 rupees. Subtracting those fees leaves your net profit, which went negative. Trading is not a guessing game. It is a business with strict operational costs. To avoid Muntassir's result, start by calculating the broker fee before you ever set a profit target. Next, resist the urge to panic sell for tiny profits. Give your winning trades enough room to ride the broader trend. Finally, track your net profit rather than your win rate to measure your true success. Understanding the hidden costs of the market is the difference between having a lucky winning streak and actually becoming a profitable trader.